So the idea of this video is just to explain the logic behind revaluation. So revaluation tends to be something that happens to land and buildings, and remember, land is not revalued. Is not depreciated. Land is usually stays stable or increases in value, whereas buildings does get depreciated. That becomes relevant when we start looking at our provision for depreciation account down here. Now, we have 2 years here. Okay, so we have an opening balance for year one and opening balance for year two, which then, when we close that off, it becomes the balance for year three, the start of year three. We're just going to look at 2 years, and we'll look at some of the things that can happen. I'm just going to ignore dates for now, but we're just going to call this first one year one, the next one year two. So let's just say we started off and we had 500,000 of land and buildings. So that means that originally our land and buildings cost us 500,000, and we think they're worth approximately that, except the buildings would have been depreciated. So let's just say, again, I'm just making up some figures here, that we have a balance and a provision of 20,000. So that means that over the years that we've had these land and buildings, that we've depreciated the buildings by 20,000. They've gone down in value by 20,000. So the book value of our land and buildings now is 480,000. Now, let's just say during a first year that we bought new buildings, so we might have, let's say, bank, okay, because we spent money, and let's say we spent 200,000 on buildings. That means our balance CD at the end of the year was 700,000, which would then carry over into next year. Okay, and that would become our balance BD for next year. Let's just say instead of buying new land and buildings, let's say we sold some buildings. So let's say buildings that originally cost us, for example, 100,000 are sold. Now I'm putting on the credit side because this type of account is, I'm just going to close that just for 1 second. So this type of account is an asset account, which means if we buy more buildings, we'll have a debit entry. If we sell buildings, we'll have credit entry. Now, this building here, if we have a disposal, so we sold one of our buildings. So let's just say we owned a number of buildings, but we sold one that originally costs 100 grand. Okay, we have to transfer that down to a disposal account. So I'm going to put in 100,000 in here. Okay. And we have dealt with disposal before when we were dealing with tabular statements. We did disposal of vans, but we have the same thing with land and buildings. So when we dispose of our land and buildings, we need to take out all of the depreciation on those particular buildings. So let's just say there's 4,000 depreciation has been written off on that building over all the years we own it. So we're going to take that out of our provision for depreciation because we don't have this building anymore. And we also want to work out, did we over or under depreciate? Do we sell it at a profit or loss? So we had a credit in provision for depreciation. Remember, provision for depreciation is a liability account. So if we're making our liabilities smaller because we're getting rid of a building, we'll have a debit entry, which means when we go to our disposal account, we'll have a credit entry. So put in 4,000 there in disposal. Now, let's just say when we sold our particular item, let's say we got a bank figure, so we were paid, for example, let's just say if I said 120,000, well, the thing was worth 4, subtracted from 100, so it was worth 96. If we sold it for 120, well, then we're going to add up that side, and we have 124 there, so we have 100 there, so therefore we need to subtract the two figures to find out what our profit is. So we know we need to have 124 here, so that means we must have made a profit of the difference between the two. So the 24 grand is going to be our profit. So, and that profit basically means in English that when we got rid of the thing, we got 24 grand more than it was worth. And that profit is something that will be put into our profit and loss as an other income that the business has made. So that's the first thing. So that's getting rid of an item. So let's just say, for example, after doing that, we have 500,000 on the debit side. So that means we must have 500,000 as a total on the credit side, which means we must have 400,000 for our balance CD there. Okay, and the same figure, 400,000 here. Now, if we just look at, so that's what all that happened in the first year. In the first year of this business, or that we're dealing with, the event that happened that we have to handle our land and buildings as we dispose of something. But we still had building at the end of the year that we have to go and depreciate. Okay, so if I said that, well, okay, our balance here is 400,000, we have to work out how much depreciation it is, and let's just say depreciation is 2%. So I'm just going to put in there 2%. So what we have to do is get 2% of what the leftover buildings are now worth. Okay, so the buildings are now worth 400,000, and multiply that by 0.02. So that's the depreciation for this year. So my balance then, when we add these two numbers together, okay, and we have the same figure as the total over here. So that means my balance CD at the end of the year is 28 minus 4. Okay, so that means I'm starting off the following year with 24 grand in my provision for depreciation account. Now let's just say at the beginning of the second year, we decide to revalue the buildings that we have at the moment. And so that means that we got an estate agent to come in and look at the property and say, look, you've got them worth 400,000. In reality, if I tried to sell it today, it's worth 600. Now, we have to have a realistic figure for our balance sheet for exactly where land and buildings is worth. So businesses do this on a regular basis. So we're going to revalue our land and buildings. At the moment, they're worth 400. If our estate agent says they're worth 600,000, so we're going to have to add 200,000 to that. And we're going to call the account that it goes into revaluation reserve. Again, we did this in tabular statements already. So we add these two numbers together. Okay, and we put that in there. So our balance CD then is going to be 600,000, and the following year we're going to start off with the same balance of 600,000. Now, when we revalue something, we have to increase the value of land and buildings, but we also cancel all the depreciation on that item up to the date of the revaluation. So the revaluation in this case, we're going to cancel, okay, which means on the debit side of provision for depreciation, this is going to happen at the beginning of the year. So first, let's say 2001, okay, where we have a revaluation, and we cancel all the depreciation that we have up to now, so 24,000. So that means that at the end of the year, we have no depreciation in this provision account, and we'll have to go and do the expense for provision at the end of the year. So we'll do that now in a second. But first, I'm going to transfer the 200,000 from land and buildings and the 24 from provision for depreciation into my revaluation reserve account. So land and buildings has gone up by 200,000. I've cancelled my provision for depreciation by 24,000. So that means the total on this side is going to be 24,000, and I have that figure there. And my balance CD then must be 224,000. So what that means is that the balance sheet value or finance, money invested in the business by the shareholders, has increased in value by 224. So the shareholders' investment has gone up by 224 because one of the uses of that investment was buying a building a number of years ago, which is now increased in value. So that's what happens there in the balance sheet. Final thing we have left to do now is for our second year, we have to depreciate it. And again, our depreciation is 2% of whatever the thing cost. Now, if we had revalued at the end of the year, then it would have been 2% of what it was worth during the year, which is the 400,000 the cost during the year. But we actually depreciated it at the beginning of the year, so that means all the way through the year it was worth the new figure of 600,000. So that means my depreciation expense is going to be the 600,000 we have there, multiplied by 0.02, which is 2%. So there's our depreciation expense. So when we add these up together, so you get 36,000 on that side, we must have 36,000 on that side, and that means that my balance CD is going to have to be the difference between the two sides, which is 36 minus 24. And that 12 grand then becomes the balance starting off the the next year when you go to do your depreciation. I hope that makes sense. That's just the fundamentals of how we deal with provision for depreciation, land and buildings accounts, and everything to do with revaluing and depreciating assets like land and buildings.